The Canadian housing market is imploding, and it could affect the major banks in Canada. In fact, there are signs it's already affecting the major banks in Canada, as we're going to get into in this video. And in this video, we're also going to be getting into the credit crunch, which is happening at certain banks in Canada. So stay tuned for that. We're going to see the arrears rate and much more as usual. So first of all, let's start off with some of the things right now that are going on in the housing market. Obviously, housing markets are falling everywhere. This comes from Shazzy and his Ajax, Ontario. This is a power of sale, so it's bank owned, and it's a $545,000 loss, a 30% loss here in the housing market. Losses in Ontario are stacking up everywhere, but it's not just Ontario. As I've shown on this channel in my series that I'll link at the end of this, there is foreclosures, losses, and power of sales that are going on everywhere. And then Shazzy also posts King City knockdown here. So this McMansion here has just sold for a $485,000 loss. Again, it was bought right at the peak of the bubble 2022, and it was just sold in 2026. And there's real denial in the housing market right now. As you can see, this is the January cope, as Shazzy writes here. And you've got one guy there that is clearly in denial about the housing market. And I put this because it is true. It reminds me of that meme completely. But if you look at some of the replies here, that guy's insane denial of reality is frying his brain, which is totally true. And then Ben posted this on X here, which is more mortgage fraud that is still going on. And this is just the tip of the iceberg if it's what's put on Reddit, which is literally what this is on. So very interesting. And basically, let's read what is happening here. So my mom wants to put her new house under my name to get FHB benefit. She owns our current house, a condo in Mississauga, and in 2023 she bought a one-bedroom townhouse in Brampton. I mean, is that even possible? A one-bedroom townhouse must be absolutely tiny, which has now dropped about $45,000 in price from when she got it. Maybe more than that, possibly. Now the closing is coming up in mid-March, and she's having trouble closing as the cost will be high, of course, and she can't rent it out as it would require a much bigger deposit and a bunch of forms. She got this new house impulsively, thinking she could make a good profit, but obviously now that's not the case. In order to get me approved for a mortgage, she's saying her friend who's well off would send me $5,000 a month for 3 months, and then she'd show these statements to the banks to get approved, and then she'd be the guarantor. So it's absolutely crazy what people are still doing in the housing market. But of course, if this doesn't go through, she'll lose her money and potentially even get sued by the developer. So people are really fearful that they're about to lose everything. So they're just doing irrational things. But all of this is an unknown to the Canadian banks. They don't even know about this. But then you've got the Canadian mortgage arrears rate hits a 5-year high. We'll get into that in just a second. And remember, I've done numerous videos on how these numbers are completely understated. I'm not going to go through that again, so we'll just get right into the numbers here. Canadians are behind on their bills, and the country's banks have front row seats to this event. Very interesting when we get onto the credit crunch in a second, so stay tuned here. Canadian Bankers Association data shows the arrears rate rose in November. This is the 90-day arrears rate. And you'll remember that clip from Rebecca Oakes from Equifax, who was saying about the number of mortgages that are delinquent. And this isn't the same number because it's a 30-day number, but it was showing how this trend is escalating rapidly. Take a listen to this.
Also, what's notable here is roughly 1 in 35 mortgage holders are missing a payment, Rebecca.
And we are still seeing those missed payment levels rising, not only on the mortgage itself, but really across the other types of debt.
So Canadians are falling behind on their bills, and you can definitely see this on this chart here. Canadian mortgage arrears have climbed aggressively from lows, so they're now back up to 2020 levels. So absolutely crazy. The CBA mortgage arrears rate was virtually unchanged at 0.25% in November, up 4 basis points from last year. The current level is the highest since August 2020 during the brief surge at the onset onset of the pandemic. That was before the epic low rate fuel boom that helped everyone forget it ever happened, which is well written there by Better Dwelling. But now I want to get onto what's happening at the major banks and which banks are seeing their loans actually go down year over year. This is their most recent quarter data from Investing Pro here. There's an affiliate link in the description. This is a tool that I use myself all the time, by the way. But I also want to show you the loans because it shows you here in this tool. So anyway, this is the Royal Bank of Canada, so Canada's largest bank. And basically you can see year over year, loans are up from $987.9 billion to $1.05 trillion. Over $1 trillion in loans. I know, it's completely insane.
Are you kidding me? Are you kidding me?
This is just at one bank, guys. It's just at one bank. It's absolutely insane. So the Royal Bank of Canada, if you're looking for a loan, they're a good one to tap up because their loans are increasing, so they're taking on more risk. And it's kind of funny because they're also saying rates are going to increase, and all these banks are seeing arrears rise as well. And we've seen the risk on the bank's balance sheets because it doesn't take a massive spike in these arrears to just get rid of all their loan loss provisions and really start affecting their balance sheet. So this is the National Bank of Canada, which has also seen a big jump in its loans year over year, up from $244.4 billion to over $304 billion. So that's a big jump there. Now we're going to get on to the Bank of Montreal's gross loans. Very interesting. They're pretty much flat. They've done nothing. So all these other banks are pretty much flat to down. So we'll get into them. So basically Bank of Montreal's loans, they've gone from $682.4 billion to $682.2 billion. So a year's worth of growth actually negative. So year over year, loans are actually negative at the Bank of Montreal, which is very interesting. Bank of Nova Scotia pretty much flat. So in 2024, $767.4 billion worth of loans. In 2025, $778.5 billion worth of loans. So the Bank of Nova Scotia, slight increase, but pretty much flat, as you can see year over year. Toronto Dominion Bank, near $1 trillion of loans as well. So $957.9 billion in 2024. And in 2025, $962 billion worth of loans. So barely any growth there at all at Toronto Dominion Bank, which makes sense considering the massive fine that they've had to pay and other things that TD Bank has been doing, like selling their stake in Charles Schwab. I mean, it's no wonder that they're not taking on loads of risks in terms of new loans. So you've got the EQ Bank, which I thought was an interesting one to include here because it's not a chartered financial institution. So that is a bank that actually needs deposits in order to issue new loans. They can't create them out of thin air like the chartered financial institutions can. So EQ Bank, they've seen their loans go down as well. They've been flat now since 2022. So for pretty much 3 years running, this goes to the third quarter of 2025. You can see they're down. So 2024, $47.36 billion. 2025, $46.59 billion. So the loans are down there. Laurentian Bank, which is Canada's troubled chartered financial institution, loans are down there. Similar theme to EQ Bank there. They've been flat to going down now for nearly 3-4 years. And basically 2024, they're actually up, but they're down on 2022. So you can see here 2024, $35.42 billion, 2025, $36.18 billion, but it's down off 2022, $37.61 billion, which was of course when the bubble was peaking. And you can see that massive jump there between 2021 and 2022. And that is because of the massive amount of loans that were took on in the housing bubble. And now I want to get to this video from CBC Watcher. I mean, again, the Canadian economy not in a good place. CBC Watcher put how it started carny. I have dealt with Trump before, and I am a good negotiator. How it's going, the head of the GM union local tells CBC News that up to 1,200 people could be losing their jobs. Just yet another blow. And many of them, unfortunately, they have mortgages to pay. And how are they going to get other jobs when the job market is so competitive? I mean, this is just the reality of what you have to look at. But it's not just GM. Take a listen to this.
Trump's trade war continues to have an impact here at home. Hundreds of GM workers in Oshawa will be clocking in for the last time today. The midnight shift is being cut at the company's largest Canadian plant as the automaker scales back operations.
So there you go. You're basically seeing them scale back operations. And this might be more indicative of what's going on with the global economy than you actually think, especially when you look at net oil exports. People think it's to do with the tariffs and all that rhetoric, but then you would see those exports going someplace else. But there's just not that much demand for it. And oil's been in a trading range now for a long time. And then this is kind of funny considering everything that we've gone over, because I saw this. Terry sent me this. Thanks a lot, Terry. Housing market poised for modest rebound in 2026, according to the BC Real Estate Association. So take a listen to this because it's kind of funny as we get onto this other article in a second.
State market, there's suggestion things may rebound in 2026.
I think that we're going to have kind of an average year for most of BC.
But it depends on where you are.
How?
In its latest forecast, the BC Real Estate Association says while most of the province is getting back to a normal pace of sales activity, it's a different story for Metro Vancouver.
I think we're going to have a slow recovery. Sales will be up and closer to like a 10-year average by the end of the year.
Why?
But probably a below average year in terms of sales for Vancouver in 2026.
Other economists agree that while there will be a bit of a bounce back because of stable mortgage rates and pent-up demand, sales will be constrained.
We do expect to see about anywhere from a 5 to 10% increase in home sales. Again, that's still a very low level. Home prices are likely to remain relatively flat. We have excess inventories right now.
It's kind of interesting, isn't it? Because they gave no reason to why the sales would actually rise. And the reason should be that the fundamentals are improving. The economy's getting better. And, you can't even look at interest rates because they're just saying that they're stable now. That's why sales are going to improve. Well, actually, interest rates are going up for mortgages. They're not going down. So that's going to have the opposite effect. And again, we've talked about this. Unless the home prices are affordable, and they probably are in some areas in BC, but unless home prices are affordable, then nobody's there to buy really. And you haven't got the investors. They're not coming back because of the rental situation. We've been over that time and time again. So there's just no fundamentals that support this right now. There's no ultra low interest rates to reignite the fire. There's just nothing going on that supports that argument right now. But it will be interesting to see how it plays out. And then we'll flip over to this because Terry also sent me this, which goes well with the other article, doesn't it? Vancouver home sales continue sluggish pace to kickstart 2026. And they were saying it will be 10% over the 10-year average. Well, they're actually 30% under the 10-year average right now. So real estate activity in the Vancouver area started a slow start this year as residential sales in the region totaled 1,107, down 28.7% from January 2025, which was a terrible year for real estate. The benchmark price for all residential properties was $1.1 million, down 5.7%, completely unaffordable for most people. And if we go back to this loss right here, it's interesting when you get into the comments here because people said, wow, $1.3 million, that's so expensive. Bear in mind, this is a power of sale $545,000 loss, a 30% loss here. People are still saying it's expensive. It's worth $649,000. Ajax, that should be $650,000 tops. And I totally agree with that because based on the incomes, that's what it should actually be. And people might laugh at that, but that's where you've got to look if you're looking for a housing market rebound. It's got to revert to the mean of affordability, and it is getting down there, but it can't get down there quick enough. So the benchmark price is down 5.7% from the same time last year and 1.2% lower than December. So that's showing more renewed weakness, not any signs of strength in 2026. Absolutely hilarious. And then you've got this. CMHC estimates Canada needs needs to build roughly 500,000 housing units per year to meet demand. Annie Balo, probably butchering that, I apologize, CEO of Build Canada Homes, I wonder how much she's getting paid, says that they've only built 9 units so far. And I do wonder how much she gets paid. And I tried to look, but I couldn't find any information on it. So take a listen to what she says here.
Land and financial tools.
Thank you. So how many of these units that you guys have done are move-in ready?
So 9 of the homes in Nunavut are moving ready. We just got the notice very soon.
Oh my God. This agency has 13 billion with a B worth of funding. I mean, it's absolutely crazy, isn't it? Just how slowly the government moves. I mean, who on earth would think it's a good idea for the government to build homes? I mean, what is Canada becoming? The USSR? I mean, it really is when it comes to these policies. Absolutely crazy. And then you've got Richard Diaz here. You've got to see this because the manufacturing recession in Canada, we went over the GM layoffs earlier, but it's now in its 32nd month. So manufacturing is a share of Canadian GDP. It's been absolutely tanking since 2001. So if you think this is purely a Trump thing, you haven't got your eye on the ball. And then if you take a look at manufacturing in the US versus Canada, you can see where that manufacturing is going. It's going to the United States, and it's very obvious there. So it's a very interesting thing. But 32nd month, and really the economy in Canada has been in a recession, as we know, since 2022. And really, is it in a depression? I mean, let me know in the comments below, because I certainly think it is in a depression now, especially when you look at how many Canadians cannot afford food as just an indicator of that. And then you've got wealth moves here. Carney says Canada thrives because we're Canadian. The IMF says otherwise. GDP per capita growth 2014 to 2024, 10 years, Canada 0.5%. Obviously, this is completely insane because this is adjusted for a CPI. So if you use a realistic number for inflation, it would in fact be negative. The US is at 20.7%. You can't really use the US in this because it is wildly skewed by the top 1% essentially. But Spain, very interesting comparisons there, and they are much, much higher, much, much higher. And you can see this on a chart here. GDP per capita economic growth laggard for 10 years. Canada clearly in a lost decade there. And then you've got Champagne, who says the same as Mark Carney. Who cares when it comes to the $12 billion worth of funding for the grocery rebate program? Take a listen to this.
CBO said today that this bill is going to cost about $12 billion over 6 years, a little higher than your own estimate. And the Conservatives say you haven't explained where this money is going to come from. So it's just going to be all added to the deficit?
I don't know.
Well, I would say when you're in government, you have to make choices. The choice we made is to support Canadians where they are. Like I said, this legislation is giving a boost for this year, but also a bridge towards the time where we grow the economy. The Prime Minister and I have laid out a vision.
$12 billion worth of money, primarily directed at food, most of which Canadians can't afford. And this shows their economic incompetence here. Because if they knew anything, just basic economics, they would know that taking a $12 billion deficit and putting it into the food sector, which is already under pressure, is going to inflate prices. That's going to happen. It's going to have one of two effects: inflate prices, or it's going to mean that there's going to be a lack of supply of food because they haven't made any food. And the next thing will be price controls, because what happens is it will inflate prices more, and then they'll come in and say, well, now we've got to stop those greedy grocery giants. And yeah, there's a problem in Canada, but it's not the greed of the grocery giants. They're just capitalizing on a market that they control and have built. And the Canadian government seems to not care or do anything about it. And that's what's stifling the competition in Canada. We all know it on this channel, yet the government's too stupid, or maybe not too too stupid. It's just they don't care. These power structures are way above even the government, and they really just remain unaffected no matter who you put in charge, and that's the main problem that happens in Western countries. Anyway, guys, I want to thank you so much for watching this video. If you've enjoyed this video, please consider checking out this video here. And if you're looking for a VPN, also want to help support the channel, please check out the links in the description below. Please sign up to my email list. It's totally free. Not many free things these days. And I will see you in the next one.